Hello, everyone. Today on the Final Bar, I'm joined by Jay Soloff from Investors Alley. We'll get an option strategy to maybe consider given the uncertainty, the volatility that we're seeing in the market. The S&P moving far back to the upside, getting up to 4470 plus. Technology really leading the way higher. Growth over cyclicals for the most part today. We're also answering some of your questions from the Final Bar mailbag in terms of how to put these recent moves into proper context. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment using the power of stock charts, using data visualization techniques, the technical analysis toolkit to better quantify investor behavior. I found that, and most times I talk about the benefits of multiple timeframes, thinking about short-term versus long-term, the flickering ticks, the noise of the market versus the larger structural trends. I think now more than ever, you have to work really hard to disconnect what's happening in one particular day and one particular hour versus the longer term trends. It's a really important time to be updating stops, to be updating key support and resistance levels. At what level, what lines in the sand would you agree to revisit a position or revisit your bullish or bearish thesis? Always an important thing to keep in mind, but especially now as we have a lot of competing narratives and a lot of quick movements in this market. I would argue, and based on the weight of the evidence that I'm seeing, I think there's still further downside to be had. But days like today certainly feel like it's offense over defense. Feels like a market in recovery mode with a lot of names up fairly significantly. Some things like renewable energy, semiconductors up pretty big today. So let's focus on some of the bigger picture levels. What levels at which we would agree to revisit a thesis or revisit a particular opinion. We have great guests on the show. Jay Soloff is going to be joining us here briefly in a moment from Investors Alley. Next guest we have on Wednesday the 16th, Sean McLaughlin from All Star Charts. On Thursday the 17th, I will be out of town. Guest hosting the show will be Julius DeKempener, founder of RRG Research. Monday, we're taking the market holiday off, so no show that day. But I wanted to point out to you next week, our latest episode of The Pitch will be airing next week on February 25th. My friend Grayson Rose from here at Stock Charts will be moderating a conversation with three guest experts. They each pitch you 5 ideas. And then as a team, as a group, they debate the strengths and weaknesses of those picks. So go to stockcharts.com/thepitch for information on that next episode. It is time for our market recap today, brought to you by Chaikin Analytics. If you go to Stock Charts ACP in the bottom right corner, you'll see a little plug icon. You can click there and look at Mark Chaikin's plugin featuring the Chaikin Power Gauge. Our market recap, we're going to start actually today with a poll. Recently, we asked on social media accounts and also on our Stock Charts TV live stream page on our website, in your opinion, what's the probability of the S&P 500 closing above 5,000 on June 30th, 2022? Less than 30% of you, 55% of you said, it was 55% of you said below 30% probability that we'd be above 5,000 on June 30th. 50% said 24% of you said 30 to 50%, and only 22% of you said 50% or more. So basically an overwhelming majority, 79% of you said 50% probability or less. And it's interesting how that question would be answered if we asked it a series of times over a series of weeks or months to see what the results are. We actually have asked that question before. I kind of want to look back and see what the response was maybe before the end of the year versus what we've seen now. But the fact that 4 out of 5 of us are saying it's a less than half chance that the S&P will be above 5,000 is pretty important. That's not too far away from where we're at right now with the S&P at 4470, right? But that's another 530 points. Certainly feels like a long way to go up until today when you get this nice a nice rally. So thanks so much for answering that poll, everyone. Let's continue on with our market recap. The S&P, as I mentioned, closing around 4470. That's up over 1.5% from yesterday's close. The NASDAQ Composite, the NASDAQ 100, both up about 2.5%. The NASDAQ Composite, we talk about that new Dow theory, which uses the S&P and the NASDAQ and looking for confirmation between those two. The S&P recently, threatening to break down, and the NASDAQ had not on a closing basis, remaining above 14,000 here today with a nice move higher back above that key support level. Interest rates pushing onward and ever upward. I was talking with Blake Morrow from Forex Analytics earlier today. We were talking about the overall market environment, talking about interest rates and just the prospect of higher rates. And when you zoom out, going back to 2018, you'll see the 10-year was over 3%. It's about 3.25%. In the fourth quarter of 2018, and obviously came down pretty significantly going into the eventual low in 2020. Now back above 2%, and days like this continuing to push that mark higher and higher. And again, from a technical perspective, from a fundamental perspective, there's no real reason why interest rates can't go much higher from here, to be honest with you. 2.25%, 2.5%, 3% are all possible. How probable is the 10-year being above 3%? I would say not super probable, but possible. And I think that is one important thing to keep in mind as you think about what 2022 could look like and what the coming weeks and coming months, how they could evolve. Remember, there are a lot of possibilities. It's all about probabilities and thinking about some of those different scenarios and how your portfolio would fare in a rising rate environment, which certainly seems likely to be coming with language that we've gotten from the Fed, even accelerating some of the rate hikes that we've been talking about and expecting for many moons now. The dollar index down about 0.4% using the UUP, by the way. Commodities overall, a lot of red on this page. The oil ETF that we use, the USO, down over 3%. Gold down 1%. Silver down 2%. The energy sector was the worst performer of the 11 S&P sector. One of the only two that were actually down on the day today on an absolute basis. Commodities as a whole, we've talked about obviously that overall long-term strength in commodities, and you've seen it in agriculture and agriculture stocks. We've seen it in energy stocks, right? Sort of across the board, you've seen this renewed strength. By any definition, I think it's hard to ignore the fact that a lot of energy-related names in particular have had pretty incredible runs so far. A pullback of some sort makes a ton of sense and still could be within the context of a long-term uptrend. I think that's what's worth paying attention to. Cryptocurrencies all in the positive including in terms of the 10 most liquid coins that we're tracking on our dashboard page. Bitcoin up just under 4%, Ether over 3,100, up 6% from yesterday. Let's look at a chart of the S&P 500 to talk about where things are at. Right at the 200-day a little bit ago, rallied into the close here and finished really at the stronger part of the day. So you opened at the lows, you closed at the highs. So nice short-term rally mode here. With the S&P closing back above the 200-day moving average. 2 days ago, that was on Friday's session of last week, right, was when we closed below the 200-day moving average. Lower close yesterday to 4,400, back above the 200-day. And it's interesting. I actually put a video on my YouTube channel earlier today talking about the percent of stocks above their 200-day, which is back below 50%. That's a key metric to pay attention to. Because the major corrections that we've seen in this market, going back to the major market low in 2009, post-financial crisis, every time we've spent a meaningful amount of time below with that, less than 50% of stocks above their 200-day moving average, the market has been in a longer corrective period. We're kind of there right now. It'll be interesting to see as we process the closing data today. With the S&P getting back above its 200-day, we might sort of be right at that 50% level. It's an important breadth indicator to pay attention to. We still have some very clearly defined support and resistance levels on the upside. We have the most recent swing highs around 45.90 and also the 50-day moving average at 4,600. If this rally that we're seeing today would continue, if you see renewed strength through the end of this week. On the downside, if this pullback would continue, I think this broader pullback that we've seen 4,300, the first logical support level. It's taking it back from September and October of last year, and also January of this year, before you get down to 4,200, which is support, a confluence of support, if you will, from a number of different indicators and previous swing lows. So a number of clearly defined support levels, clearly defined resistance levels as well. It's an interesting market, a volatile market, chopping around and really trading in an equilibrium, trading around some key levels all around the current price. Just to finish up our market recap here, obviously I mentioned earlier sort of growth at the top of the list with technology up 2.7%. MPWR was the top performing name in the S&P 500, up almost it's 10% today. NVIDIA was number 2, up 9%. So semiconductors really pushing to the upside. A lot of airlines in the top 10 list as well, cruise lines, and also something like Enphase, ENPH, which is in a group called Renewable Energy Equipment. It includes like hydrogen names, batteries, what else? Solar stocks are in there as well. That's the top performing group. So those are the 3 top performing groups coming out of a fairly, sort of sideways consolidation phase. A lot of those names had given back a lot of their previous gains and just really trying to roll up to the upside. So certainly important groups to monitor. On the downside, it's a lot of energy in the bottom 10, as well as utilities and materials, mining names and gold miners at the bottom. Not down a ton today, and we'd highlighted things like BHP and Rio Tinto previously as interesting names, starting to or trying to create a rounded bottoming pattern, giving back some of those previous gains today. On the downside is utilities, bottom of the list. Energy at the bottom of the list, utilities next from the bottom, everything else in the green today. We need to take a quick commercial break. We'll be back with today's guest, Jay Soloff. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thank you so much for joining us every weekday after the close as we break down the market activity using charts, using the technical toolkit to better understand investor behavior. A couple quick comments before we get to today's guest, Jay Soloff. First off, we welcome your questions. We're going to do the mailbag segment a little later in today's show. We would love to feature your question in our next mailbag segment. Go to your email, thefinalbar@stockcharts.com, to get us any of your questions. We'd love to hear from you. Also on Twitter @FinalBarSCTV, or on YouTube. Put a comment below the video you're watching on our YouTube channel. We'll gather all those questions and hope to answer one of yours live on the air in our next mailbag segment. Also, go to StockChartsTV.com. That's our on-demand platform. It's completely free. Special guest takes by Jay Soloff and many other knowledgeable guests coming through Stock Charts TV. Our special events like The Pitch, our market outlook from January. Larry Williams is doing a special here in the next couple days. We'll be featuring all of that as on demand for free at StockChartsTV.com, or on your mobile device. Just search for Stock Charts TV on demand. I want to welcome on today's guest, Jay Soloff. Jay is coming to us from the Phoenix area. He's the lead options analyst at Investors Alley. Jay, Happy New Year. Good to see you, and welcome back to the show.
Thanks for having me. Glad to be back.
So we're looking at FCX, Freeport McMoran. You always do such a great job of sort of talking through a potential options trade and how to make sense of it. Talk us through FCX. What are you seeing?
Sure. And, it makes me look like really good in retrospect that the stock was up like 3% or more today. But I promise I sent in this chart yesterday. So
Noted.
So Freeport's a company I really like. I've always really liked it, and it doesn't hurt that it's based here in Phoenix. A little partial to the local companies, but mostly known for copper. They have copper, gold, oil exposure. It's a big company, but it mostly moves with copper. I think copper is just it's a great asset right now because it kind of fits several narratives, right? That commodities in general are good in a rise. You mentioned earlier, interest rates should be going up. throughout most of the year. Commodities tend to thrive, particularly anything that's a real asset or something that's going to be used for infrastructure or real estate. I mean, this is stuff that tends to do well in inflationary environments. Um, Interest rates, can cause havoc in the commodity market, but generally, though, you have something like copper, which is just necessary for so many things, and then the other part of that is that it fits sort of the green narrative too, because copper is an important component for electric vehicles. It's important for renewable energy. So really, no matter how you look at it, I think you can find a bullish case for it. Now, the flip side of that is that, how high is it? It's been on a nice run, right? How high is it going to go? There are still supply chain issues, geopolitical. We know what's going on with Russia, Ukraine. There's geopolitical issues that could pop up anywhere. So that over the short term, that could keep a cap on how high this could go. And that's why I think the covered call was a perfect trade for this situation.
It's such a great example of where this this particular option strategy, the cover call, could be a really interesting way to play this. How would you actually put it into practice here?
All right, so cover call, great sort of entry trade if you're new to options, or if you're an experienced option trader. You're simply buying the stock and you're selling the call, generally at a higher price, at a higher strike price. So in this case, when I priced this out, stock was about 42.50. You can see there, I was looking at 45 as about a potential ceiling for about a month. Right now, it doesn't have to be. And when we look at the price table, you can kind of see that you could do a 46, you could do a 44. There's a bunch of things that were reasonable there. I chose 45, kind of the midpoint of where I thought the stock might go. And all you're doing is, again, you're buying 100 shares or in lots of 100, and you sell one call for every 100 you're buying. So in this case, we're looking at the March 18. You can see the arrow up there. That's about 30 days. I like to do options every 30 days, generally when I'm doing covered calls. The reason being that it's a good combination of collecting enough premium to make your return on cash nice, but not too long to where you every 30 days you can basically reset the call, so you're not missing out on too much potential upside, or if the stock goes down, you can sell something closer to the price. So it gives you this reset ability while also collecting decent premiums. Now in this case, the 45 is trading about $1.50. You can see the arrow down there, the 45 calls. That's not quite 4% in a month return on cash. So that's a nice amount of premium to get for something that I believe has a reasonable floor. We talked about all the positive fundamentals, and not also, the chance of this thing shooting up to 50 or something like that. You're not giving up too much upside there either. Now you could do 46 again. You could do 44. You could do. They're all reasonable. In fact, with today the stock at 43 something, I'd probably do the 46, right? So, but it's easy to adjust that, and that's another great thing about covered calls. You want to tweak it a little bit. Very simple to do.
Now, the cover call strategy in general, I mean, when you're thinking about the overall market, where you sort of laid out the case for copper, but does the overall market structure, the fact that we've given up so many of the previous gains, I know it's sort of an uncertain period, does that make you want to lean into more of a defensive play like a cover call, or what's the macro overlay to what you just described with Freeport McMoran? Does that impact it at all?
Yeah, that's a great point, because covered calls can certainly smooth out your returns a little bit because you're collecting that premium, which if you want to look at it in a different way, it's essentially lowering your cost basis on the stock. So if you're just buying Freeport and the market sells off, you're better off with the covered call version of it than the regular. The other side of that is more the option side of it, the volatility side of it. When the markets drop, volatility goes up. That works for both puts and calls, right? So you're getting more premium out of selling your calls in a volatile market. So generally speaking, I would expect this to be a good year for cover, good period for covered calls in general, just because while the market's choppy, you're getting some nice premiums from all the options being sold.
Yeah, that's a bunch of great points in there, Jay, and certainly there's no doubt we've seen an elevated volatility environment. No signs of that changing so far today. Listen, Jay, it's awesome to see you. Thank you so much for coming back on the
Thank
show.
you.
You always do a great job of laying out options trading and making it seem super straightforward and accessible, and we appreciate it very much.
Thanks, you, Dave. Appreciate it.
That's Jay Soloff. Jay's the lead options analyst at Investors Alley, coming to us from Phoenix. And I was mentioning to him before we started with the show. I don't use a lot of options in my own investing. I'm pretty boring with my own portfolios, but I know talking with people that are trying options out for the first time, cover calls a lot of times are a really good introduction to the idea. Thinking about strike prices and premiums and how to think about volatility and all these other influences that actually impact option pricing and how to structure them. It's a really good introduction to it. It's a relatively low cost way to get some protection given uncertainty in the market. Great take there from Jay Soloff. Let's continue on today's show with the Final Bar mailbag. As a reminder, we love to hear from you. Questions on anything are fair game, and our email is thefinalbar@stockcharts.com. Let's get to the first question. Dave, using your market trend model, it may take many months or years to have an entry. If I enter the market using a medium-term PPO signal, is it advisable to stick with a medium-term PPO exit? Or do you think it is okay to switch to a long-term PPO exit signal? It's a really good question. And it's funny, as I go through here, I had a couple questions on the market trend model that I've been talking about a little more because it's been negative now, bearish on the short-term and medium-term timeframes for the last 4 weeks now, 5 weeks, if we would continue this week, which is pretty unusual. It's been bullish for, especially the medium-term model had been bullish for quite some time. And so I'm getting a lot of questions on what that means. And again, I would remind you that, the market trend model that I have used for a number of years and actually tweaked it last year a little bit, given what was happening in the market. It was really meant for me to have a shorthand, a simple way of gauging whether or not we were in a bullish trend or a bearish trend. I was taught early in my career, a rising tide lifts all boats. You really want to understand the big picture of what's happening. If you think of Bill O'Neill's approach, the M in CAN SLIM is market, which is the market going up or going down. And David Sato Chung and others there do such a great job of trying to portray that market environment and make sure you're on the right side of things. But for me, it was trying to come up with a simple way of gauging on multiple timeframes what the trend was. And I would not make a trading system based purely on this. And that's not what I do. I really don't automate anything based on this model. It's a way for me to have a model running in the background that informs the rest of my decision-making process. So for me, when the medium-term model is below zero, when it's negative, which it turned down in early January, that tells me to think more defensive than offensive. It tells me to think more about downside protection as opposed to looking for new long ideas. And I wait for that to turn positive to really think about getting aggressive. Now, in any environment, I think a good chart is a good chart, and I will show you whether or not the market's going up or down. There are charts that are working and charts that are not working. So this doesn't alleviate or eliminate the stock picking or the stock selection process. It just tells you to give you the overall bias. So what you were suggesting is, it could be many months or years to make an entry, and you're absolutely right. And again, it's meant to track the overall longer term trends. Arguably, that medium term trend has been bullish for quite some time for stocks, so I'm okay with it, turning positive and then not giving a lot of signals for quite some time. And that's probably my roundabout way of answering that. So, could you combine these different timeframes? Absolutely, and it's not meant to tell you how to invest or tell you what to do, and combining these in a meaningful way that helps you understand the markets better, absolutely go for it. But for me, the medium-term model is my main risk-on versus risk-off gauge that I use to sort of keep in mind as I'm looking at all the other charts the rest of the days. The first chart I look at every morning. Next question. What are your triggers for when to take advantage of a buyable dip? It's such a good question, and I mean, we're limited in terms of the amount of time that I could use to answer it, and I can't give you a lot of answers, but I would say that there are a number of different things that go into it. When I'm thinking about the overall market environment, I think of the larger trend, right? I go back to Charles Dow's very simplistic way of approaching things, which is an uptrend is a pattern of higher highs and higher lows. A downtrend is a pattern of lower highs and lower lows. And when we pull back, my initial thought is look to the left and see if we've maintained a higher low than previously, right? We're going to pull back in an uptrend all the time do we keep pulling back at a higher level than we did previously? When that stops happening, it tells you that there's a potential real change of character. And that's what concerns me about what happened in January. It's not that we pulled back, because we've pulled back many times in the last 18 months. It's that we undercut decisively the low from early December, the low from mid-December. And I think that is enough to tell me that we're seeing a change of character, or likely a change of character. So for buyable dips, pulling back to the 50-day moving average had been a fairly consistent way of doing it. A low higher than the previous low and showing signs of accumulation. The RSI bottoming out at 40. Those are all buyable dips with an established uptrend. When that changes, which I would argue we are now no longer seeing, we're seeing the RSI become oversold and unable to break 60 when it bounces back higher. We're seeing lower lows than we did previously. Then it ceases to be a buyable dip. It's something different. I think by that definition, we're in a different environment now. Next question. If one is trading the S&P 500 futures intraday, is it ever a good idea to calculate the 200-day simple moving average using the current futures contract? Or is it better to always calculate the 200-day simple moving average using the SPX and then make an index to futures adjustment? Really good question. And there, when you're looking at the S&P or the Dow or the NASDAQ or any of those, you now have a lot of different ways to track those. So just for the S&P, you have the S&P futures, you have the S&P cash or the index, you have the E-minis, you have the SPY, the SPY, and a bunch of other ETFs and funds that all track a basket of 500 names that we're talking about here. So there are a lot of ways to do it. I have tended to use the S&P and its closing data as sort of the main benchmark, regardless of what I'm going to trade. And then I would think of futures and options and ETFs and whatever else related to the S&P are all derivatives of that chart of the S&P 500. I will tell you though, if you're trading, if you're looking short term at something like the futures, you really want to look at the contracts you're trading, and the same with ETFs. If you're trading the SPY, if you're trading the E-minis or something, I would be looking there because the opens a lot of times would be very different. The closing prices and where they're at, the shapes of the candles and everything could be very different. And I would be focused in particular on what you're trading. Chart what you're trading. As long as it's liquid enough and the data is good enough, I think you're going to be in the right place at the right time, particularly intraday. On longer term charts, there should be a ton of difference, and there will be a little bit of like a difference from premium or discount to the net asset value in a lot of cases on things like ETFs and futures, but not to the degree that I think it should really impact your investment decision. So I would be looking at the vehicle you're trading, assuming it's a liquid instrument, which hopefully you're trading a liquid instrument. Anyways, the S&P futures certainly qualify. It's all the time we have for the mailbag. Please keep your questions coming. We get so many great questions, and we'd love to answer yours in our next mailbag segment. We need to wrap the show and go to the 3 and 3, 3 charts in 3 minutes. Here we go. Chart number 1 is the Russell 2000 ETF. I mentioned I was talking with Blake Morrow, does a great job over at Forex Analytics. We were talking for the Traders Summit portal, where I write some content for them pretty regularly. My interview with Blake should be up tomorrow, later this week. We were talking about this chart, the Russell 2000 ETF. And what I was explaining to him was, he was asking, how much is the weakness in the Russell tell you? What does that tell you about the overall environment? I said, listen, for the Russell 2000, same as with the NASDAQ, which you have to remember, it's a big universe of stocks, and the lower end quality-wise are pretty junky, right? The worst stocks in the Russell 2000 are not great companies, and these are stocks that are probably not going to make it, right? You compare that to the S&P 600, which is a much smaller list of companies that are probably a lot more viable. So you have to remember that when the market goes risk off, you will feel a lot of pain in the NASDAQ composite and certainly from the Russell 2000 just because of the composition of the ETFs. Having said that, they were in a long-term basing pattern. That base was broken to the downside in mid-January. Now we're retesting that previous support level from below. If I'm bullish on the market and I'm looking for the market to recover from here, the Russell 2000 would need to break above this trend line connecting the previous highs. It has not done that yet. It would need to get back into that range and remain there and not break back below that support around 210. It has not done that yet. And so this could be setting up for a rally into resistance before the next leg lower. That's why it's an important chart to watch. Chart number 2, NVIDIA. I mentioned semiconductors, one of the better groups today, which is absolutely true. NVIDIA was up 9%. Empower was up even more than that, over 10%, if I remember right. I think these charts still have a good amount to prove. NVIDIA could be in a very buyable dip, a very nice rally off of the previous lows. 240 is the level to watch there after bouncing off of the 200-day, similar to what you saw in March and in May of 2021. if that would break. If you break the 200-day and then break 220, I think has the potential to go a lot lower. At this point, it's one of the better setups right now, and it's all about if it can continue to hold that higher low. All eyes on 240, I would argue, for NVIDIA. Soybeans, my last one, SOYB. Nice rally, pulling back a little bit, but remaining above potential support there at 24.50. Keep an eye on that chart. That's our show for today. Special thank you to Jay Soloff from Investors Alley joining us from Phoenix. For StockCharts.com, I'm Dave Keller. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.